I take the mask off? Well, hello everyone. Welcome to the second panel of the day. My name is Amir Sayedi, and I'm going to be the panel host today with my three dear colleagues who will be the panelists and will help me during this panel. In this panel, we are going to talk about market risks, financial risks that are considered by everyone that is active in financial markets. We can see that during the past year, in the effects of COVID and pandemic that we had in the world, we saw a very volatile market, and we saw different kinds of risks that affected all people who are active in the market. This may bring in the question to everyone to think about what they should do to confront these risks. Well, in the literature and if we take a scientific approach, these risks have been categorized in different kinds and types. For example, we have credit risk, market risk, foreign exchange risks, and different kinds of risks that may affect each investor. We would like to bring some questions to our panelists today in order to bring light to some of the aspects of the risks that are affecting everyone who is active in the market, because we think that today much more retail investors are active in the market, and if someone would like to stay in the markets for a long run, this is very important that they have a plan and they have a strategy for the turbulent markets and the times that risks are really high. Because if you want to stay for a long time in the markets, the most important thing is that when there is a huge amount of risk in the market, you can keep your capital and you can protect it in order to use it later on when the markets are more stable and ongoing. I'm going to start asking questions from the dear panelists. First question will go to Albert. I would like to ask Albert, how can the emotional and irrational behaviors of investors could be controlled in the time of a crisis such as COVID-19 that we have seen in the past year? Sometimes it will lead to panic sell-off. What is the role of market regulators when the market risks are increasing? And if you can have a talk to our viewers about this topic, I would thank you a lot.
That's a great question, and let me first start off by saying it's an absolute pleasure to be here, and my heart goes out for everyone during these unprecedented times, and hopefully soon enough we'll be coming out on the other side as a much stronger alliance and union of the world as we need to be during these times. But back to your question, I think it's very important to reiterate that during, speaking of how can we control these irrational behaviors. Irrational behaviors in the market have occurred. They're endogenous to the system, but they've been occurring since the beginning of time, and they'll continue to occur today and well into the future. But one thing is, with today's world, we're in a much more technologically advanced world, especially after COVID. We're even more exponentially technologically advanced and universally have adopted these technological advancements in almost all fields of our of work and in our lives. And so one of the effects of that has forced us to shorten our time horizon significantly because of the faster environment that this technology creates. And so while these behaviors with the technological advancements, we have more efficient markets and much more liquid markets and easier access. When you have all these technological advancements that create such a faster environment, although you may not have as many systemic problems anymore, you're still going to have irrational behaviors that cause systemic downfalls. And so, and they're going to have a higher likelihood than we tend to on average believe that they'll occur. And so when these do occur, because of this much faster environment, when they do occur, they tend to be extremely volatile and painful for the investor. And so that's something that's, risk management has had to focus on significantly as a whole, because the overall strategy has been forced to shorten its time horizon and become much more tactical in nature. And so while when quantitative asset management was just starting out and you would build your quantitative models purely based off of valuation, because the time horizon was much longer during that time, and the data information gap was much wider in the disparity than it is today. That was a sustainable strategy. And while that is still a sustainable strategy, still the overall average strategy has been forced to shorten its time horizon, even if maybe they're not as tactical as some have become, and shorten their time horizon significantly. I think overall, in general, time horizons, even of the very long-term investor, has had to shorten, purely because technology has sped up everything. And so what does that imply when you have these tactical components, and how do you mitigate, what does that mean when you're shortening your time horizon and adding more tactical components? There's tactical components you can use to take more advantage of these shorter time horizons, by trying to capture and smoothen out the edges of the trend with using mean reversion and momentum. But in terms of risk management processes, the main tactical component being used that we have found to be the most effective has been volatility. And that's because volatility tends to have a lot of information about the overall market and contains a lot of information just based off of the way that it's reacting. And so we look at absolute market volatility, cross-market volatility, but also the volatility of our overall models as an indicator in and of itself. Because when we need to mitigate these risks of irrational behavior and heightened systemic overall market volatility goes up, generally the behavior of our models, if they're not calibrated to that correct volatility regime, they will act differently. And so they will act out of sync. And so really what the goal is, I'm not saying that we can predict volatility or anything like that, or that we're trying to. It's trying to recognize when the volatility regime that you've calibrated for has changed. And so what does that mean? When the volatility regime changes, during that transition period of volatility regime, your models tend to, when they make a mistake, which every model makes mistakes and they have a probability distribution and oscillation period of when that will happen, when they do make the mistakes during that transition period, unfortunately, is when they tend to be most costly. So instead of trying to design models that would quantitatively maximize the likelihood of being right all the time, you're trying to manage and accept the fact that these probabilities of these events happening are going to occur. And instead of trying to minimize the model being caught by one of these events, you have to be able to scale out. And so when we're looking at volatility and looking at the volatility of the overall models, as we said, as an indicator, that can inform us when there is a structural volatility regime change. And when we need to scale out, we do when that happens. And so we scale out tactically and reduce overall, degross our exposure and to mitigate that specific risk. And when that risk goes back down, the same is applied. And so the reason why volatility is also very effective in this specific event of a systemic downfalls or uprises, but irrational market investor behavior is that when you have these events that do occur, and you're using these tactical components to be able to mitigate these risks, you have to be able to, first of all, you have to be very quick. But the beautiful thing about the volatility as an indicator is that it becomes more effective during these systemic downfalls. And the reason for that is because when the market gets highly, when there is a systemic downfall, there tends to be a higher cross correlation of the market. And also when there is a systemic downfall, generally volatility indices, which are based off of option implied volatilities, tend to go up as well. Now, I'm not saying that higher implied volatility implies systemic crash, but when a systemic downfall does occur, it does tend to accompany a heightened implied volatility of the options. And so when you're getting a higher cross-correlated market because of this systemic downfall, and you're using volatility as an indicator to manage your risk and mitigate these specific risks, your hedge and indicator becomes more effective across these overall asset classes because they're converging to the same correlation. And so that allows you to have a lot more information on the overall market and help dictate and when to scale out and mitigate these specific scenarios. Like I said, these tactical components have allowed you to take more advantage of some of these scenarios, but also when you're talking under a risk management perspective, it really is looking at volatility and being able to scale out degross in time for instead of trying to predict the right move, just not being able to get hurt so much during the transitional period. And so that brings me to my point of I was talking to my colleague recently, and one of the main, back when the strategies were always thought of to have the absolute and relative risk management as a sort of separate and independent component, but now it has really become of the investing strategy, it's really become the entire aspect of the investing strategy, or if anything, a significant component because of all these tactical and shortened time horizon environments that have forced you to almost adopt these kind of risk management procedures. And so, with that being said, that's the main thing that comes out of this is the most important aspect, as I said, is using all these indicators and these tools, is that you have to have your diversification of your entire process. You have to have diversification of your data now, because we're all converging to one universal source of data. One advantage is that so many people have ease of access, but that also means we're converging to one average universal source of data. So now you have to stand out with data again, and it's almost a self-fulfilling backwards prophecy. So as I said, you have to diversify your entire process. That means down to the data, down to the portfolio you choose of the asset class composition, down to the models that you're designing, the algorithms that you're using. You have to build every component of the comprehensive strategy independently, make them modular by design, and then integrate them all. Because there's so many things that you can't rely on trying to account for being correct. You can't maximize likelihood. You have to accept that these events are going to occur, and you have to work on mitigating the transition and making that as smooth as possible. And by diversifying your sources, you not only mitigate those risks and spread them out evenly, you also have a completely unique process that can handle those kinds of situations. And it's because you have diversified sources of risk management, and thus, since risk management has become such a major source of investment strategies, now it becomes a significant source of diversified sources of alpha. And so I do believe, that's how our models have been saying, what they've been indicating to us on how to mitigate these kinds of risks, but these behaviors are going to persist. And there is one thing I do want to say, though, is, and this is on the extent of regulatory framework. While regulatory goal is to mitigate overall systemic risk and ensure proper liquidity in markets. One of the very interesting things is that in today's world, I'm a full proponent of allowing ease of access into markets for the everyday investor. We're 100% for that. There should not be any limit to that, and there should be full in support of allowing and reducing barriers of entry and education to the everyday investor so that they can get into the markets as well, which provides liquidity and diversifies the funding source of the overall system. But however, I do think they still need to be informed of the risks that they're taking, which I do think they are. The one thing that I do think was very interesting, and I'm not saying this necessarily needs regulatory work, but I do think needs regulatory analysis to be able to do research analysis on this topic, so a lot of information can be gleaned from this, and I think will be very useful for regulatory agencies, is doing analysis on what the overall big tech business model will have the effect, as we've seen with some brokerages, the trend of lowering commissions to basically commission free, and that cost is being passed on by selling order flow. And so these clients are basically, investors are being changed from the client to a commodity that's being traded by the big firms that are buying this order flow, or that are purchasing advertising and attention time on these devices. And so that big tech business model has already been under extreme scrutiny under very unregulated industries, and the financial industry is extremely regulated relative to its counterparts. So I do think that would be very interesting research and analysis that should be done, and I know it has been done. Janet Yellen has also mentioned that, and so I think will be a very interesting case study to see, how does that model really have an effect? Because we saw with very small cap stock that there were at times where the brokerage was potentially not able to meet all of their liquidity requirements with their counterparty of the clearinghouse. And so I do think that would be very interesting aspect, and I do think that's where regulators can really start to look into and perform research analysis, which I know has already been done. But I really think now, with especially the pandemic and such a fast, rapid adoption of technology throughout an entire economy, not even in sector, but every single field almost has been affected by this. And so that is going to be very interesting to see how an already regulated industry will take on this business model that has become so popular, and the sheer size that it has attracted with the scalability. We'll see what systemic risks that can create, and will certainly be interesting to find out. But I think that's the role that the regulators need to take. I definitely don't think we need to limit the investors' involvement in the markets. They provide liquidity, and liquidity is incredibly important in efficiently functioning markets.
Well, thanks a lot. Another question for you, Albert, here, can any financial instruments, such as embedded put options or basically any kind of derivatives, help to mitigate the risk in the market?
That's also a great question, and that leads me also similarly. That segues into the previous question, and my previous answer was, I'm going to look at. We focus on a macro scale, and I view things in a more macro way, and so just looking at a macro view of financial products, just overall derivatives in a macro view of, do I think these are effective in mitigating risk in the risks that we were just talking about? Absolutely. And this goes into my previous conversation of volatility. I think with the markets going down, when they had their systemic downfall and their systemic upfall, options are a great way to take advantage of these pricing anomalies, especially when volatility is being has a pricing anomaly as well, with options having the price and the volatility being major components of the pricing components of the options themselves. I think there were many opportunities, and still are, to be taken just based off of using those derivatives, especially the sheer volume that we've been having. But they are very important, and the wonderful thing about derivatives, especially in using them in mitigating these risks, is that they can be customized, they can be implemented using various risk profiles, and they can also be implemented to essentially they can be implemented with varying degrees of risk profile. And so they are very versatile, they're very low cost in what their uses of effectively hedging or mitigating any risks of mitigating specific risks of the portfolio. And they also tend to require very little capital. And so while options can have virtually unlimited risk and are incredibly risky instruments, when used properly, they can be a very effective and efficient complex hedging tool at very low cost. And so one of the main, for example, if you're looking at more of a lower risk profile, a very risk averse way to hedge and mitigate these risks is, for example, right before the COVID pandemic, is again, when I said previous to my answer, looking at volatility is another indicator. When indicator was very undervalued relative to how the market was performing, and put to call ratios have been incredibly low. The sheer popularity of calls have been extremely evident with the bullish behavior. And so when volatility was underpriced, as well as tends to be the case when the market is going up, because the volatility indices are based off of implied volatility, not absolute volatility of deviation from the mean, the absolute the square root of the square deviation of the mean. So what that means essentially is that when volatility is extremely undervalued and prices are skewed towards the call side, to buy portfolio tail risk hedging, essentially, it would have been relatively cheap to buy puts, out of the money puts, to hedge tail risk at a very efficient and undervalued price when volatility was still undervalued at that time. And if you didn't want to use the income of your portfolio just to pay the premiums of the hedging, and you were viewing it as an insurance premium, you don't want to pay those premiums, you could have also, because the calls were overpriced relative to the puts and to their synthetic counterparts, their synthetic exposures using underlying, you could have sold those calls to cover for part of the cost of the puts, and still, since they were overvalued, you could have replicated those exposures using the underlying securities and captured that difference. So that's just an example. Obviously, that's a very obvious example, but that's a very risk averse way of taking advantage of those pricing anomalies, because you're buying puts, you're not selling puts, and you're selling calls, but they're all covered, so you have those securities, so you're not risking yourself in any way of selling naked options. And then you can elevate your risk, of course, and when you could make markets and replicate, because the volatility is so high, the options are overpriced on both puts and calls relative to their synthetic counterparts, so you can make a market and sell the options and buy the underlying synthetically to replicate your exposures and keep a delta adjusted market neutral exposure. And when I say it's a much riskier strategy, it's a much more active strategy, because you have to manage your exposures in the sense of, if you don't hedge them with those synthetics, you're going to be massively exposed, and you essentially have unlimited risk, and you're exposed to volatility as well, so it's a 2-for-1. But when you're managing and you're selling those options and underwriting them and making a market, especially during these periods of heightened volatility, they're extremely effective in generating a stable, consistent income, and can help reduce the exposure of the overall portfolio and just conduct volatility arbitrage. And also, I was going to say, speaking of, again, on volatility, if some people aren't comfortable with options and they don't want to implement options, there's also another very effective tool, the volatility, for example, volatility index contracts. For example, the S&P 500 future, if we say, just as an example, you can really use that as an effective tool, and you can isolate just the volatility exposure without worrying about the pricing component of the options. Now, with that said, you can still replicate the exposures using beta adjusted exposures relative to the underlying of the volatility asset that you're using, but you're still not having to worry about the pricing component as well. And so the beautiful part of this hedge is it becomes more effective in the more systemic risk becomes. Because generally when systemic risk occurs, the higher cross-correlated markets, as we mentioned before, tend to converge. And so the correlations converge when the markets are going down, and volatility tends to go up. That hedging of that use of the hedging tool of the volatility index contract becomes more of an effective hedge towards all of those asset classes. So it becomes and if you price it relative to options, it can be cheaper too. So it can be an even cheaper, a low cost of capital, and a very effective portfolio hedging tool. And so in my overall answer, yes, I do think those, from a macro point of view, that's what I focus on. I definitely think these kinds of derivatives products, while can be extremely risky when used in ways that we've seen with exuberance, they can also be when very sophisticated and complex and efficient, effective ways to hedge many risks, and you can target those too. So yes, we definitely believe that those are useful, and especially in today's fast technological environments, they're very useful and at times almost required.